Understanding real estate investment groups, REIGs. A real estate investment group, REIG, is a business entity concentrated on the investment and management of real estate properties. Operating with a group of investors, REIGs buy, renovate, sell, or finance real estate to optimize profits. This guide delves into the structure, operations, advantages, disadvantages, and key considerations when engaging with REIGs. Key characteristics of REIGs. Partnership structure. Typically, REIGs are formed as partnerships, bringing together two or more partners who contribute capital to acquire real estate. Diverse investment opportunities. While focused on real estate, REIGs are not confined to property investments. They can engage in various activities such as property management, rental income operations, and financing properties. Operational flexibility. Unlike real estate investment trusts, REITs, REIGs aren't bound by specific regulatory frameworks and can modify their business structure based on their strategic plans. Investing through REIGs. What is involved in REIG investment? Investing in REIGs involves pooling resources with other investors, allowing for broader investment strategies. Often, REIGs focus on acquiring multi-unit residential properties, assistance in property flipping, or management of commercial buildings. Typical revenue streams include rental income. Returns are often derived from the rental payments made by tenants. Property sales, selling renovated properties or developed units for profit. Management fees, collecting fees from property management services provided to other owners. Attracting investment. REIGs often attract high-net-worth individuals looking to invest in real estate without the hands-on burden of property management. This partnership approach appeals predominantly to investors interested in diversification and reduced risk through collective investment. REIG structures. Partnerships. Structure. In a partnership setup, profits, losses, and debts are distributed among members according to predetermined agreements. Tax benefits. Partnerships are pass-through entities, meaning taxes are handled on an individual basis, reported via K-1 forms. Corporations. Formation. REIGs may also be structured as corporations, either public or private, which allows them to sell equity shares to raise capital. Management. Corporate structures tend to be governed by an executive management team, whose performance greatly influences the success of the investment strategy. Crowdfunding platforms. The rise of real estate crowdfunding platforms has democratized access to real estate investments. These platforms often function similarly to REIGs, allowing both accredited and non-accredited investors to pool resources, facilitating investments in larger projects. A notable example is Fundrise, which allows individuals to invest in various real estate strategies without high capital requirements. Advantages of REIGs. Diversification. Investing across multiple properties and sectors can cushion against market downturns. Pooling resources. By pooling capital, REIGs can undertake larger and potentially more profitable projects than an individual investor might manage alone. Management expertise. Work led by seasoned professionals generally leads to better investment strategies and outcomes. Disadvantages of REIGs. Liquidity constraints. Because of the investment agreements in place, withdrawing funds may not be instantaneous. Members could face delays even in accessing their income. Operational costs. Fees can diminish profit margins, particularly during challenging economic times. Management risks. A poorly managed or inexperienced team can lead to losses, highlighting the importance of evaluating management expertise when choosing a REIG. REIGs versus REITs. What's the difference? While they both focus on real estate investments, REIGs are fundamentally different from REITs. Feature REIGs. REITs. Structure typically a partnership or corporation, publicly traded companies. Regulation less regulated, more flexible operations, highly regulated, must disclose financials and pay 90% of profits as dividends. Liquidity typically less liquid, longer capital commitments more liquid, shares can be bought/sold on exchanges. Control: more direct control by partners managed by professionals, less direct control by investors. Joining or starting a REIG. Finding a REIG. Investors interested in joining a REIG should conduct thorough online research or actively participate in networking within real estate groups. Platforms like LinkedIn and associations such as the National Real Estate Investors Association can serve as great resources. Required capital. The minimum investment varies by group, generally ranging from $5,000 to $50,000. Each REIG sets its own rules and fee structures, which new members should understand before joining. Evaluating a REIG. When assessing potential REIGs, consider the following. 1. Track record: look for groups with a history of successful real estate ventures. 2. Transparency: ensure clear communication about investment strategies and performance. 3. Management experience: evaluate the expertise of the leadership team. 4. Regulatory compliance: confirm that the group adheres to applicable laws and regulations. Starting your own REIG. Starting your own REIG requires thorough market knowledge, planning, and the ability to recruit interested partners. Core steps include: developing a solid business strategy, establishing rules and regulations governing member participation, marketing your group to attract potential investors. Conclusion. Real estate investment groups can be a powerful vehicle for investors looking to diversify their portfolios and engage in real estate without the burdens of management. However, like any investment, they come with their own set of risks and considerations. It's crucial to conduct extensive research and due diligence before committing capital to a REIG to ensure alignment with personal investment goals and risk tolerance.